Welcome, everybody, to the Fire Chat Podcast. I am your host, Rich Rice, and today on the show, I have my beautiful girlfriend, Miss Caitlin Weaver, the insurance weaver. Caitlin, say hi to everybody.
Hi, everyone. My legal name is Caitlin. You guys can call me Kate.
I don't call her Kate.
It's my new thing.
That to be called Kate? All right, I'm going to have to work on that because I still call you Caitlin.
Well, you can call me Caitlin, but you do know I go by Kate
With
because
a little bit of inflection when I'm annoyed at you, like Caitlin.
Yeah, that's when
rare.
I'm in trouble.
Which is rare because she's a perfect angel all the time.
No, it's because people will spell the Lynn part wrong, so it's like,
You mean like right when
What's
it's
the
on the
point?
board, like right in front of the picture they just took, and then they still spell it?
Yes. I get the L-Y-N. I
Not
don't
messing
get the
anybody.
L-A-N. Okay, it's not
Caitlin.
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 Anyway, that's another story.
All right. So Caitlin's been on the show. Kate has been on the show many times before. A couple times. I think you've actually been on the show more than anybody. So
Yeah,
lucky you.
I'm pretty much always here when you're here. So.
Yeah. So we thought it'd be cool. But it's been a while, though. It has been a while. I think the last time that you were on the show was in February of this year.
Beginning of February.
Yeah, beginning of February, which coincidentally, we have found out that we are pregnant and expecting and having a baby.
Yeah, I don't always
here.
look like this.
Having a baby here in about a month. So, but what's funny is the last time you were on the show is you were pregnant the last time you were on the show. We just didn't know yet.
No, it was definitely, I was only like a month. And it was right after Firefest, right before a family wedding, and right before the cruise.
Yeah.
And right before the kids class. So
Yeah,
there was a lot going on.
So we're expecting a baby girl, Evelyn, in why less than 4 weeks, 29 days is her due date at the moment. So it's coming quick. We
29 days, yeah.
We had a lot going on. So we thought it'd be cool to, get you back on the show, obviously, just, because it's been a while. And
Lots
also,
of changes.
well, before she gets here and talk about some of the changes and talk about some of the, how our goals have, definitely maybe not so much changed, but have been redirected or altered in certain ways and other ways not, enhanced. Yeah, that's, in some ways. And so we're going to talk about that a little bit. So also, let's talk about first, before we go into all that, Caitlin recently started, Kate, sorry, I'm going to try and call you Kate.
You can call me Caitlin.
Recently started a new venture. So we're going to talk about that a little bit as well, as her new ventures in insurance and life insurance and all kinds of insurance. So where do you want to start? You want to start with the insurance, or should we start with the goals? What are you feeling?
I mean, I can give a little bit of background about me and insurance. And
let's do that first. That's a good point. So what brought you here, Caitlin? Kate?
Well, getting out of high school, I didn't really know what I wanted to do. It's I feel like that's for everyone. So I did go to college. I studied business, and I just happened to be able to get a part-time job with my mom's company, which was insurance. Mm-hmm. And she was doing insurance before that for probably about 7 to 10 years before she started her own business, with the, inspiration and help of my dad, and who actually pushed her to do that. And so while going to college, I was fortunate enough to work part-time in her business, help her out, and also go to school full-time. So I pretty much packed my schedule to go down to school 2 or 3 days a week, depending on when it was. And then I also played soccer during that time as well. For the junior college I went to, Valley College. And it was a great experience because I learned more dealing with the customer service of the business and, figuring out how to deal with people I learned a little more than college. But of course, college keeps different, stuff in line, like deadlines.
What did you major in college again?
It's business. It's business entrepreneurship because I always knew I wanted to have my own business. Didn't know exactly what industry I would do it in, but before I wanted to do business, I wanted to study nutrition and become a nutritionist or like a dietitian. And that's because I like to eat and I want to make sure I'm staying healthy. And if I can help other people too, that would be my ultimate goal. So I think everything ties kind of back into helping people, because helping my mom with her business allowed me to do that, which I was able to help people and learn at the same time, go to school, figure out what direction I was going to go in. And then
how'd you originally get into real estate? You bought your first house.
Well, real estate, so that's the thing with the insurance. I pretty much specialize in home insurance. So I'm looking at homes all day, every day. Got to see different types of homes, and I primarily looked at them in the mountain area, which I grew up in Crestline, California, Lake Arrowhead, all the way up to Big Bear. And then, there's other high-risk areas in Southern California, like the hills of Redlands, the hills of Rancho Cucamonga, Highland, Riverside Hills. So I wanted to like expand the business into other high-risk areas because a lot of people don't specialize in that and they don't really understand how that works. And mind you, this was 11 years ago, so a lot has changed since then. Now I feel like everything's high risk in California.
Seems like it.
But ever since then, I used to play soccer in Redlands, California, so I always loved that area. And I used to like drive around Redlands, nicer houses and just look at houses all day. And I just always loved houses, so I feel like that's always been a passion of mine. Is real estate. And my dad's been pretty much a landlord my whole life without him understanding that he's been a landlord and a real estate investor. So I always wanted to do that. I always wanted to buy multiple houses and rent them out and provide housing for people in my community. So my family home was going to be sold by my grandpa, who basically... he used it sometimes, but not that much. So he was finally getting ready to sell it. And I was like, well, I kind of want to keep the family home. It's a lot of good memories. And I want to get my first house. And that was in 2020. So I was able to talk to him and pretty much just say, hey, I'll buy your house. Like, I want to keep it in the family. I want to either make it my first home or rent it out. So I was able to buy it from him before he put it on the market and got it at a really great price. And I got a really good rate.
You got
and
a really
I just
good loan.
bought.
What was your rate?
It was 2.75.
Yeah.
Yeah. Now it's
Nice.
like 3.0 or something. But anyway, 3.25. So I didn't realize like how that would jumpstart my career in real estate. I just kind of did it and just kind of learned from there.
Now, when you did it, like, was it more of, like, did you do it as, like, did you have the idea? I mean, because obviously you've now redone it and rented it out. And when you got it, was it just like hey, I could do this kind of thing? Or like, and you just wanted to live there, or...
I had no idea what I was getting into. I did know I wanted to buy real estate at a young age and pretty much start building my assets as soon as possible. Because I've been working since I've been out of high school and I wanted to start building true wealth. I didn't want to just keep working my job that I've been doing since I got out of high school. So that was my main goal, was to start building wealth. And it's not supposed to just stop with the one house. So I guess I kind of needed a little bit more direction on how to actually truly build wealth. There's a lot of ways to do it with different vehicles. And I wanted to use real estate as one of the vehicles, and then of course also investing money, because I was also learning a lot about Robert Kiyosaki and the cash flow quadrant and the 4 ways we earn money, which is either you're an employee, you're a business owner, you're self-employed, or you're an investor. And so I always wanted to be in that investor quadrant, which means your money is working for you.
While you're not working.
While you're not working, yeah. Self-employed, you'll always still be working. You know, you still have a job. Business owner, you're not working, but you have business and overhead. You got bills to pay. Exactly. There's overhead. And then, of course, employee, which would just be having a job, a paycheck, which can be taken from you at any time. So I always wanted to direct my, time and efforts towards investor and learn more about it. And I still have a lot to learn. I'm still learning something new every day. So,
well, hopefully you will always continue to do that.
Yeah. That's the goal. That's the goal for sure, is learning new things, especially with a lot of new things coming for this year and next year and for the rest of our lives.
Yep. So, so you buy your first house, and then, I know we went into this on some of the other episodes too. So if you want to learn more about what she did and how she bought it and a lot of the rehab stuff that you went into, I think we covered that on a couple of the last ones, but it's been a year now since it's been done. You've rented it out. You got a couple tenants or a couple residents now. And how's now that, looking back the last year or so, how has been a housing provider? Is everything you ever imagined? Is there some lessons there? What?
Yeah. I mean, the best thing that I've learned is the more you set yourself up or try to prepare for the unseen circumstances, the better off you are. So the more that we've prepared, and he's helped me out, and just preparing for unforeseen circumstances. Some things are just out of your control. That's for sure. I mean, there's always going to be things that happen, but the more that you prevent them in the beginning, the better. So yeah, I could definitely say there's been a lot that I've learned that I haven't expected in the past year. Luckily, not too many things, just certain things here and there with weather or toilets.
You've also had, you've definitely had, I will say, I mean, you've had, more maintenance related issues than with your, the units you have so far, than I have. I was lucky that well, with the exception of one of, or a few of the units, like I got them, pretty turnkey. I bought them like that, or I had, they'd already just been redone one way or the other. And, so you've learned firsthand on, your own property on what exactly goes into all this stuff. And then thinking you've, had it all covered, and then still having to do a little bit of maintenance, but luckily it's just been little things, toilet here, a little bit of a water leak there, hasn't been right.
Hasn't been bad. No, crazy. Yeah. Comes with the territory, I guess. Cause like I said, I bought a family home that needed a lot of work, years old. And it is almost 100 years old, 1929. But so I pretty much knew that going in, that's to be expected. And I've been very lucky so far. I love my house. I love being able to provide a house to my tenants, which, that's the goal for the next ones.
Yep. So let's talk about insurance a little bit. So you mentioned high risk area, without getting too much in the weeds with that, like what, for those people listening that maybe want to, or maybe they try to invest in a high risk area, or they want to invest up in the mountains or other areas that might be considered high risk, and then they go to get a fire policy, and get told they have to have 2 policies. Why is that? What does it look like? And, how can you help?
Yeah, so there's a lot of changes, like I said, that has happened in the last decade. I don't follow a lot of politics in insurance, even though that is what runs most of these companies and why a lot of California companies have been pulling out of the state, because it is all numbers. It is all sometimes politics, but I don't like to follow that too much. I like to provide a service to my clients and educate them on their coverage. Whether that's through one company or the other, that's their choice of what I can provide to them. So nowadays, yes, in the high risk area, the only option really is a fire policy and a wraparound policy, or also known as a difference in condition policy, acronym of a DIC. And difference in condition literally just exactly what it sounds like. It's the coverages that are different from the fire policy that aren't included in the fire policy. So, some loans, some bank loans, institutional bank loans require the DIC policy, some don't. So it's sometimes ultimately up to the homeowner if they want to carry that policy. But of course the fire policy is the main coverage, you never know when something's going to happen. That's pretty much the major catastrophe coverage, which is most important in California, being California.
And people always call that the fire policy. Is it just fire? Like, is it, and they usually typically go with what, California Fair Plan?
Yeah, so...
Is that just fire, or is there other coverages that go with Fair Plan?
There's other coverages that go with Fair Plan. So the California Fair Plan is actually not a California company. It is a pool of funds which has been put together by the insurance commissioner. And I recommend you do your own research, or...
It's like backed by the state, essentially, right?
Yes and no. So because it's not a California company like Allstate, State Farm.
It's not private.
Yeah. There's just pools of funds by a government-backed company. And like I said, I recommend you do your own research. However, if it's the only choice you have, take it. You gotta do what you gotta do to suffice for the loan. If you own your house outright, then you have more options. However, that is pretty much the only option for most homeowners in the high risk area, especially if it's a primary residence or a secondary home. There are more options if it's a rental or a vacation rental, because those are almost technically considered commercial uses for the property, even though it is a residential property, not a commercial property. Anyway, that's a whole nother discussion.
But does that cover, does the Fair Plan cover, does it give them anything other than fire?
Yes, I can go into coverages. Again, I'm just an agent. I'm not an insurance claim adjuster or anything, so I can't say exactly what is covered or what's not. But there is other perils on the fire policy, which perils equals cause of loss. So fire would be a cause of loss. There's also wind and hail coverage on the California Fair Plan, which a lot of people are usually surprised at that coverage. But basically, yeah, if it's windy or there's a hailstorm, that would actually be covered on the California Fair Plan. Okay. There's also vandalism and malicious mischief if it's chosen to be purchased.
That's if you want to pay for it, right?
Yeah,
it's like
and it's
optional.
It's optional. It's not that expensive.
What's the typical minimum? What the bank's looking for? I really
hazard
is it just
insurance. Okay. So usually hazard insurance equals fire and wind coverage. You do have to have wind coverage to suffice for the bank loan.
And that's typically that's your I guess primary insurance, or
that is the primary coverage. Yeah,
is that what they call it? Okay.
And then primary or hazard coverage. Yeah, a lot of banks, like I said, they might not require that second policy, and the reason that's important is because if they don't require that second policy, if your bank is impounded with your insurance and taxes, they won't pay for that second policy if they don't require it. So that's just another thing with homeowners and what we have to deal with, and escrow accounts.
Yeah. And then if you wanted to do a second, to protect your personal property, that's where that they call it wraparound, but it doesn't seem like it really wraps it. But
it does wrap it in a way. However, the wraparound not only covers personal property, it will also cover the structure itself, depending on the cause of loss. So if the cause of loss is covered on the wraparound, It will cover the structure and personal property. Like, for an example, weight of ice or snow, depending on how it happens and how the loss occurs. And then, of course, plumbing burst damage. So that's a typical coverage that's not on the fire policy, but it's a more common, claim that might come in is a sudden burst of pipes. And this only will repair the structure damage, which is like walls, flooring, or personal property. So it doesn't actually cover the actual pipe itself. So this is why a lot of people, they're like, why do I need updates? Why do I need to have my plumbing within 25 to 40 years? Or why does my roof need to be within 25 years? And that's because, they want to make sure things are updated before they cover you. Something's not 50 years old or 80 years old. And then you have a sudden burst of a pipe and then they have to pay out. So
yeah, they're trying to limit their risk of
they're limiting their risk
as much as possible, right?
So that's a big thing too nowadays. Is kind of like I have to ask, what are the updates? How old's the roof? Electrical, heating, plumbing. That's pretty much it.
So what is obviously you're a licensed insurance agent. There's certain things that you can give your opinion on, and others that you really can't. So if I ask you a question and it's more of like an opinion thing, just let me know. So what on these coverages, like, is there, in your opinion, one or two or whatever that people like maybe don't have I'll ask you two different questions here. So like one, let's start with this one. One that people maybe overlook or don't have enough coverage when it comes to their house. Like that they're undercovered on, that you see a lot, or things messed up that you see a lot that you'd like to maybe bring light to, and then I'll ask you the second question after you.
Yes. So for, the beginning of the conversation, I said there's not a lot of people that specialize in the high risk area. So for me, it's really important having an agent that understands how California Fair Plan works. So if you don't have an agent that's close to a mountain area, I just recommend getting another look or a second opinion on your coverages. One coverage that a lot of agents will miss is debris removal. And that is a coverage that you would have to pay out of pocket if you don't have it on your California Fair Plan. Which could be a lot of money. And it could be a lot of money, especially if there's asbestos. I don't even want to get into it. But anyway, it's a big out-of-pocket cost that you do not want to pay for. And if you're unaware of it because your agent doesn't have it on your policy or they don't even know to explain it to you that you should have it, that's just a major thing for me and my mom that we come across that a lot of agents
just don't have debris removal.
Yeah, they
because
just
if you think about it,
it.
Your house burns down and you're left with a giant pile of rubble that might or might not have hazardous material in it.
Yep.
There's
a lot of demo.
Go take a pickup truck full of trash to the dump one time, and it'll cost you a few $100 to dump that load. Imagine times your house.
Yeah. And to restart the building process, the county is going to do everything they can to make sure you're doing it correctly. And that might require a certain type of hazmat removal, making sure nothing hazardous is still on the premises. So it costs a little even more. You can't just hire anybody. So, depending on the situation.
So, all right. So debris removal and then...
then, like I mentioned, there's two extra coverages that's required on the California Fair Plan. Like I said, wind and hail is required for your mortgage. And that's actually the part of California that is called extended coverages. Not extended replacement costs. It's extended coverages. That has to be marked off on your policy in order to have wind and hail. And then I also mentioned vandalism, malicious mischief. That's usually less than like $50 for the year. I recommend just having that.
And I thought that was crazy, like that you had to have extra coverage if somebody like intentionally damages your property. Like let's say you have a resident and they beat the crap out of, maliciously. Not that they just like damaged it through the course of, wear and tear, but like they literally like busted out all your windows or something when they moved out. That wouldn't be covered on a normal policy, right? You have to
without
have this
vandalism.
Extra, which I thought was, I was like, really? Like what? Like they think of anything to add on, I guess. But the other one, which I know maybe you could hit on real quick, is especially for investors, is entities and like how they're properly named, and then the proper coverage too. Because I know you've caught that on my policies before. Yeah, so you want to touch on that?
Two major things in insurance, because let's be honest, companies are going to do whatever they can and not pay out. And this isn't from personal experience. It's just what I've seen in the industry and what I've heard. But occupancy and name insured is really important. If you ever have to file a claim, we want to make sure the policy is written correctly. So entity being that the name insured on the policy must be matching the name on title. This includes trusts, corporations, LLCs, or your personal name, or if there's two names on title, both names should probably be on the policy. That's just a no-brainer.
So if you have your, if you have your property and your property's in a trust or an LLC,
yes,
but your insurance policy is just to you personally, and it doesn't mention that trust or LLC, they can and a lot of times will deny you based on that. So
yes, and
so that's a big
I
one.
have seen it happen.
So it's attention to detail. It sounds like
it is attention to detail. And this could happen. It could be a customer's fault or an agent's fault. So you as the customer, make sure your agent knows. Make sure you put it in writing. Make sure we put everything in writing. As an agent, I can't change anything unless it's in writing. If you say, "Oh, I told you over the phone," 3 months ago, I don't have it in writing. I need it in writing. That's just for me too. Whenever I get off the phone with someone, I'll put it in writing so that they remember and recap the conversation. That's just professionalism in any business. But especially being a licensed professional, I do need to make sure that, I'm covered on my end. Yeah. And then the second one,
I'm sure that's part of your, when you, what's the name of the title? Who owns it on title?
Yes.
Kind of thing. So.
The second one was occupancy. So if I say it's my primary house and I'm not living there more than 6 months out of the year, then technically it's not my primary house, and they could try to investigate how I'm actually occupying the home. And this is a big one, like Andy always brings it up, for vacancies. So if the house is vacant and you haven't been occupying it, and then someone breaks in or vandalizes, and you've been saying, "Oh, it's my primary house,"
but nobody was there keeping an eye.
Nobody was there. There's no furniture in it. That looks a little suspicious.
Yeah.
So occupancy is a really big deal, and of course, vacancy, occupancy.
Anything
is more expensive.
that you, I guess, should have been paying more for, but you were paying less for because you didn't disclose or whatever. Like they're gonna try and nail you for it, right? So, and then let's talk real quick on. I know we recently did this where we looked at all of our deductibles. You want to explain like that caveat that people think that they usually have to pay their deductible like out of pocket if something happens, but that's not necessarily true, right?
It's not true. Yeah. So most of the time in a major payout, they'll just deduct your deductible off the top of the payoff. Now I get that, insurance is there when we need it, and, we should be able to use it. But sometimes if the claim amount is going to be $5,000 and you have a $2,500 deductible, is it worth it to make the claim? That's your call, So we always advise our clients, you make the claim. I wasn't there, so I can't explain it for you. You have to explain it or submit it online or do whatever. But deductible does play a role, so we'll remind you of your deductible. And if we're recommending a higher deductible to keep the cost down, then you're probably not going to call in the small claims. You're probably going to want to have an emergency fund and take care of those on your own.
Which it seems like in this day and age, like if you call in anything that's other than like a major thing, like it's almost like you're gonna end up paying for it anyways, because they're just gonna,
unfortunately,
even if they're not supposed to, or whatever, it's like they're gonna figure out Like the house always wins.
Yeah, unfortunately, and it's tough being in this industry. You're basically selling something to someone that's mandatory that they don't want to buy, but they got to buy it. So it's a tough industry, and insurance and making sure we have the right coverage, that's another tough thing. But claims and making small claims, that's when it gets really tough, because would I ever make a small claim? No, because I know that insurance is already hard to get. We only have so many options. If we get denied from those options, then we really have nothing. So
you're stuck with
the
fair plan or whatever else.
Or
and
sometimes the fair plan's not even
right. I mean, we've talked about this too, like where, I think I don't remember what I said, but I was like, why don't we just just take the lender coverage?
Yeah, that's an option.
What's the pros and cons of that?
The only con to that, well, there's probably more, but the major con to that is that you will not get paid out for the replacement value of the structure. So if you did want to rebuild the home to where it's at today, you probably won't have enough money to rebuild it where it's at today, because you're only covering the loan amount. Maybe the loan amount covers it.
So if you bought your house more recently and you maybe only did it with a small down payment, the lender coverage might be, depending on what they charge, obviously. If the lender coverage is higher than the fair plan, but, I thought that was interesting. At what point do people just say, screw it, we'll just go with the lender coverage and, hope nothing happens. If I only had $50,000 worth of equity or something, maybe I'll just take the risk. I don't know. Ideally that's not the ideal situation, but do you think people would be forced into doing that someday? Like, do you see it going that way, or,
if they can't get coverage with California Fair Plan, that's pretty much the only option they have is lender.
Does Fair Plan actually deny people? I thought they had to.
No,
right.
You can get denied. Yeah, you can get denied. Then number one is, let's say you have a vacant policy for a year and you don't prove that you basically change that occupancy. So if you don't move in within a year, you don't rent it out, you don't put furniture in it, you don't show that you're going to move in, they'll deny you the next year. You can only have 1 year coverage as a vacancy. Let's say you have a flip going on and you have the California Fair Plan and you've been covering it for a year. If you don't sell it in that year, they're not going to renew you for the next year, unfortunately. That's a real tough one for investors.
You better get on it.
You better sell it within the year.
Yeah, do something with it.
The second one is corrections. If they put out corrections that you need to repair your roof, cut back your trees, fix your site, whatever the correction may be, you need to get it in within that year.
Yeah, they try. They come up with
if you don't communicate with your agent, or you don't yourself send pictures or that signed correction letter, it's a deficiency and you will not get renewed. And there's a lot of clients that we deal with that, and it's not going to happen overnight that they get a quote. They flag the property address, and you're not going to get a quote until those corrections are accepted. And unfortunately, California Fair Plan is so backlogged. 3 months, 6 months, they're so behind because they're so bombarded. And that's just the reality of it. And other than that, I'm not sure why they would deny anybody.
Yeah, right.
They just want you to follow their rules and regulations. Like, they're backlogged. Yeah, they're busy. But if you just do what they need you to do, and you have a great agent that knows how to communicate to them or with you about them, sometimes it's easier for you to call the company than your agent, because we're so bombarded too as agents that the customer gets through clearer.
I mean, I can tell you, from things that I, when I don't have so much anymore, but when a lot more of the properties were on Fair Plan, and you had a better idea of what they were looking for, where it said, like, on the paper, like, you got to do this and this, and I think you were like, well, they're really more looking for this, like, and that comes with, the experience of dealing with them.
Yeah.
So,
like, if they say your trees are too close to your roof line, sometimes it's just the angle they take the picture. Sometimes you'll have to get them cut back. Yes. But sometimes if you just angle the camera up and show the gap between your roof line and the tree.
The guy who took it
just
from
send
the
the
street
camera.
made it look like it was like right on top of it, but
exactly,
it's really not.
Exactly.
You know?
There's a lot of different. And if you have a good agent, they will let you know, hey, I need these pictures. Let's send them in. If they still don't accept them, then you might have to do something different. That's pretty much how this company works.
Yep.
But
and you do all type, just so people know, like you do, you know, obviously you know your way around fair plan and all that very well. Property coverage,
yes,
flood insurance. You know,
we do
extra,
flood insurance. We do earthquake insurance. Those are
the more.
Those are separate policies, so those will never be included on your homeowner's coverage. So if you think flood is covered on your home policy, which means water coming from the outside in,
it's rare,
such as rain,
Super.
it won't be covered.
Never.
No, never covered. You will have to have a flood policy, and some lenders require flood.
Is that water? Does that include a roof? Like if your roof leaks?
No, roof leaks are different.
Okay, so water coming in from like the side walls or like the foundation or whatever.
There's certain terms on what they consider flood, which is a certain amount of water throughout the whole floor.
Just curious,
line.
what if like your hose breaks on the, you know, that's part of your plumbing system, but it breaks and then the water goes to the outside and comes back inside.
If it's from your plumbing, then that should be covered on a homeowner's policy. However, I'm not an adjuster, so I couldn't tell you.
Yeah, I was just curious.
But yeah, if it gets super complicated like that, yes. However, I have seen people put in claims for the sewer main, like from the street to the house. Some companies don't cover that. It's supposed to be covered by county or city, whoever's managing or maintaining
like if something
the sewer main. Yeah.
Interesting.
Well, water backup's different. See, that's another coverage that you should talk to your agent about it. So water backup is from the outside in through drains. So if your shower backs up or your toilet backs up, and
floods
covers your whole house, then that might be a coverage you want to consider. But like I said, we're not making like the small claims, you know. It's ultimately up to the customer what they want to do, but there's not a lot of options, and I want to make sure I'm covered. So
yeah, for sure.
Just try to prevent everything from occurring. Yeah.
Now, when it comes to, I mean, it's not all, you know, obviously you do a lot of home based or like home policies and whatnot.
Yeah.
But that's not all you do. You've started a new company. What was the name of that again?
So my new company is The Insurance Weaver, and he helped me come up with the name. And that's a play on my last name, and it pretty much explains what I can do. I can weave through what you would need, what you might not know you need, what you might consider. And this includes untangling the web of insurance, or laying out the web.
Yep.
But basically, like I said, insurance for home and auto is something that we have to buy, that we not necessarily don't want to buy, because most of the time we're not really getting anything out of it in return unless we absolutely need to. Most of the time that's just
for most people that's something that they pay for that
you'll never
need. So but that's not the only insurance that you do.
I do.
The focus is on this is more.
My new focus for the new company is towards homeowners and investors, or aspiring, entrepreneurs and business owners, because a lot of the time we're so busy focusing on our business that we forget to make sure that we're also, investing in ourselves, protecting ourselves. A lot of the times in business, we are the key man of our business. So there are policies out there that make sure your business is protected if anything were to happen to you. Also specializing in mortgage protection and equity protection, which would be more for real estate investors that, they might have a great portfolio of assets and they're already building their estate and they already have everything in order. But what happens if something happens to them? Is their spouse going to be okay? Does their spouse know what to do moving forward? And it's just stuff that we just don't think about every day. But
and there's like stuff out there that people can So like if they have those issues, or like if you're concerned about, like for me, obviously, like, I mean, you are very, in tune with pretty much everything that goes on in the business, but you don't know like every single moving piece. Like if,
No. To be honest, if anything happened to you, I wouldn't even know where to begin. I'm serious, especially with your properties, especially with your businesses. And I think that that's something important to look at, know? Or if you don't have a significant other, then who would it go? Who would be responsible? Is it going to be your parents, your siblings, your friend? It's just knowing before.
Yeah, not that's
everyone doesn't
and it's
know.
Double-sided thing too, right? It's like talking asset planning and then like asset protection. Obviously your insurance is part of your asset protection type of stuff, but it also can be part of your asset planning and all that, and estate planning and all that, right? Because it's like, if let's say you had everything like buried in trusts and you had that all, and maybe it's all laid out in like a living trust. But like if people A, need help putting that together, or B, like just what happens while all that stuff's getting separated and untangled, like to kids or spouses or like, so what, like, where can you help people with that?
Well, first is legacy protection. So if you don't already have a will and trust, the will is great to have, but ultimately you will need a living trust to protect your spouse or family from probate. I can offer recommendations for lawyers, or I also sell a program through Legacy Shield that will put together a trust with lawyers as well. So I could help in that area. I can also help with mortgage protection or equity protection, meaning if you're the breadwinner of your family, or you collect a lot of rents, or you're the property manager of your business and your spouse doesn't have every detail of what you do, then that's another discussion, making sure that they're going to be okay. And that would be either equity protection or mortgage protection. And that pays your spouse to make sure that they're still able to make the mortgage payment, or they're still able to manage stuff, or hire a manager if you're not around. The other things we could focus on is starting investing in your kids early. Something that I wish I would have known about earlier or as a kid, which I'll be doing for our daughter. And the reason that age is such an important thing for life insurance, because if you're going to be
finding out,
I mean, if you're going to be investing in something, why not invest in yourself? If you're going to be paying that auto policy, and you're able to afford more coverage for yourself, I recommend it. And this comes into also like long-term care coverage, or it's also called living benefits coverage, which would pay out while you're alive if you need it.
And why would people need that? Like, that's because I don't think people really think, or maybe even know how much, if you have to go into like, if you live long enough that, you need to go into a home. These homes aren't, we're not talking even just a couple $1,000s a month. It's more. It's a lot more.
Yeah, it's like a couple thousand, almost like a day or a week.
A week. Yeah. Well, it depends on how large you want to live,
when we're that
twilight.
age.
Yeah, it might
that's
be.
That's the other thing is inflation protection. Yeah. If you think millions are a lot now for retirement, what's it going to be in 30, 40 years?
So how does some of the with that in mind, like, that it might cost you $10,000, $5,000, $15,000, however you want to, live out your final years kind of thing, and like, if you don't have money set aside for that, like, there's insurance products out there that would help pay for this or pay for it, and like, how does that work? Like, is it?
So it will pay out if you lose like your daily living functions. This includes eating. I can go through them, but there's 6 of them. That's like eating, bathing, walking, wiping. Like it gets, it gets personal. So
Yeah.
when you can't do that anymore, you're either going to go on Medicaid, which is a state program for the elderly, which doesn't exactly cover much. Or you can also tie into a long-term care policy that you've purchased many, many years ago, pretty much setting up for in case this happens. And you get a certain amount a day for the rest of your life. And this will either be a standalone long-term care policy or it'll be a rider attached to your life insurance policy, which also has a death benefit, which means you'll still pass something on to your family after you're no longer here. So,
and correct me if I'm wrong, the life insurance, the typical life, when we think of life insurance, we think of just, the death benefit. I think that's what most people think of as life insurance, and they don't necessarily tie it to the long-term care part
or other benefits.
Like what?
There's also a cash accumulation in policies. So a lot of very, very wealthy people will use life insurance as another retirement vehicle, because if you're making a lot of money and you have a Roth IRA or a solo K or other retirement accounts, you can only max fund them so much. Right now, a Roth IRA is $6,500 a year. Pretty sure a lot of investors and a lot of wealthy people make a lot more than $6,500 a year. So they use life insurance products to pretty much, it's called max them out, max premium, max fund. They call it max fund. And they put it in a cash accumulator and it plays on the stocks, and it's called an index fund, which means it grows like a staircase and it never loses in the market. So this is a little bit more safe than the stock market, a little bit more safe than retirement accounts, because you could always lose in your retirement account. But life insurance, you'll never lose with this type of policy. There's a lot of different policies, but this is one that I've invested in since I was 23. And when I start making a lot more money, I will max fund it and I will use it as a retirement vehicle when I'm older. As a sort of like an inflation guard, like $1 million. Has $1 million now to me is a lot of money, but $1 million now to my 70-year-old self, not that much money. And this is due to inflation, and it's just the inevitable,
Yep. And And I want to go back to that like long-term care thing too, because there's a few off the top of my head that we've talked to like elderly homeowners that really all they have is is like the equity that's in their home a lot of the times. And that just gets eaten up so fast, or they didn't do the the maintenance on it. Like there's just one family up in the mountains that we tried. We didn't end up buying their house. We couldn't come to terms that would work for them, because they had lots of deferred maintenance on this house. It was a big house. It was worth a decent amount of money, and it was mostly paid off. They had a lot of equity. They had like $300,000 worth of equity, but they wanted to sell it to net like $500,000. And the sole reason they were saying that number is because they planned on living another, there was 2 of them at the time. The lady ended up passing away. But at the time they needed like $500,000 because they were both spending like $7,000. I think it was $8,000 a month for either both of them or I think it was like $10,000 a month for both of them, which is fairly low
in a living facility,
in an assisted living facility, and down the hill. And that doing the math was like they needed that to be able to like live, but the problem was the house was only worth $300,000. you know, and it didn't, unfortunately, like there was no way to get them the other two. And I don't know what they ended up actually doing, but like, I don't ever want to be in that position to like feel like I've done well my whole life and then have to did it right, did it, you know, paid off the house, you know, raised the family, the kids are all, you know, doing okay, and then boom, trying to figure out how to fund those last like 10, 15 years of, you know, when you can't necessarily, you know, decide or know when it's going to end, right? Like, like pizza. You were talking to Pete Fortunato about this when he was out here, right? And he was, what did he say? Like, do you remember this? Like when he was, he was like, what do you have the date picked out? You know, like that you're just going to go, you know, just off yourself or do whatever. Like, do you have that date picked out? Like, when's the date of your suicide was basically what Pete said.
Yeah. If you think you know when you're going to die, when are you doing it?
You know, that would make it a lot easier, but a lot of us, you know, most of us don't, you know, we don't know. It could be, you know, 105, it could be 95, it could be 82. You know, that's a big variance. And what's cool about, I think, what these policies that you're talking about is you don't have to know. Like it'll cover you either way up until, you know, right? Until like, it doesn't matter if you end up living another 10 years.
Yep.
You don't have to stretch that money. It's just there. And right?
Yep.
Am I wrong on that or? Yeah.
Yep. The biggest thing with life policies is you just have to keep up with the cost of insurance. So if you get into a permanent policy at a young age, your cost of insurance is very, very, very low, and it will not ever increase as long as you keep paying that policy. If you go with a term policy, unfortunately, it will run out. Whether it's a 10-year, 20-year, or 30-year term. Unfortunately, when that term is out,
as in you live longer than the term was for.
Yeah,
that you bought
if you live longer than the term, you basically are like paying another auto policy for no reason. You'll never get anything out of it.
You're not a fan of term.
You never get anything out of it. You never get anything back. I'm not a fan of term. There are some life insurance companies that will sell you term policies and tell you to invest the rest, which they're basically telling you to give them your money for something that you'll probably never use, and they're telling you to go invest in the stock market, which you might also lose money in. So basically just telling you to lose your money. And I'm sorry. I'm very passionate about it. I don't like term. Yeah. I don't like term.
And what's the other one?
The other one is called a permanent policy. There's a lot of different permanent policies. It could be whole life. It could be universal life. Universal life can be index universal life or variable universal life. And there's also a lot of other standalone policies. There's one that's just called final expense policy. If you're older and you can't get life insurance, you can purchase something called final expense, and at least you have a little bit of something for either funeral expenses or just final expenses that may need to be covered from your family, to not burden your family. So, there's just a lot of different ways you can invest in your retirement. One of them using life insurance as a vehicle to get there. Of course, we're going to use real estate to get there, but like you said, with that elderly couple, all they did was real estate, and then they're trying to sell their real estate in order to live another 10, 20 years. And, sometimes maybe you don't maintain the real estate, or maybe something else happens and, like the thing we just learned about, reverse mortgages and stuff like that. Yep. So we're very fortunate that we're educated in different ways to build our retirement, to make sure we're going to be okay at retirement. And, we've learned about lending. If we do get a lump sum of cash, you can always lend it out for a return. Or you can throw it into an annuity and we can go from there. That's a whole nother discussion. That's another product in insurance.
What's the short version of how that works?
Short version of annuity is almost like it works like a 401k, except you never lose in the market. You get paid out a monthly income for the rest of your life. It'll never run out. And it's transferable to your family upon your death. So unlike retirement, which will run out, annuity will never run out. And it's constantly growing.
And I've never understood, is that, because I'm learning all this stuff too, obviously. Is that tied to these other stuff, or is it separate? Or
it is an insurance policy. It's not rated on your health. And an annuity, you typically need a lump sum of money to invest in the annuity. It's not a monthly premium. So if you got $100,000 laying around, we would recommend opening up an annuity, growing it for the next 10, 20, 30 years. Then by the time that growth occurs, it'll probably be, who knows what the value would be depending on what you invest in. Annuities also never lose in the market, so it's protected retirement. And then you could pick how much you want to get paid out for your retirement for the rest of your life. And then it'll also transfer to your family.
Gotcha.
Gotcha.
So, and are these, obviously we've been talking about this a lot because we're expecting, and, I've never really looked into these policies. I wish I would have looked at them when I was younger, obviously, because I mean, like we were looking at a policy for, and you pay, because you've had it for a while too. You pay how much a month? Like, for, you pay, we don't have to say the numbers, but like you pay a third less than I am looking at paying for a similar policy.
With a less death benefit.
Yeah, with way later,
Yeah.
And so it's like, yeah, you get in early, even before you think you ever need it. Because then if I would have done that, I would have that lowered.
And it's think of it like another subscription price.
Yeah.
If you are going to pay for Netflix, Hulu, Apple Music, whatever you guys pay for monthly, just add life insurance as another subscription. And I guarantee you it'll change your mindset on the benefit that you're getting. Hulu is not going to give you anything back. Netflix definitely won't. It's just how you're educating the next generation on what's going to be truly important in life. And don't get me wrong, I like my Hulu, I like my Netflix. But there's certain other ways that we can get around it, like we don't pay for a subscription like that. So
and we are like, very much, obviously, I mean, we're kind of running out of time here, so we didn't get to really talk about the goals and stuff, but like, our things are changing. We're having a baby, and, making sure now things are becoming, more, that stuff's coming up a lot more, protecting the assets, asset protection, estate planning, and, making sure all the things are in a row. And I find myself definitely wishing that I would have taken care of this earlier, because now I feel like I'm scrambling, on some of it, not all of it, but
wait, say that again.
It's recorded. You can you can rewind and play it again. It's okay.
No, and it's not that he's saying, it's not like any regrets or anything, but if there is something that we could recommend for younger generation, early 20s, or if you're in your 20s and you don't really know what the next step is, just learning about how money works, really.
Yeah.
How retirement's going to work for you.
Yeah.
If you are a business owner as well, and you may be older, how is that going to look if you can't produce in your business anymore? What are you setting up aside from your business that's growing for you? Remember the cash flow quadrant. Investors have their money working for them, not working for their money. So how can you get your money working for you if you can't afford to invest in stocks, or you don't want to, or it's way too risky for you? There's insurance policies out there that'll do it for you. If you can invest in real estate right away, but you are a property manager and you have a book of business that you manage rentals, what happens if you can't manage rentals tomorrow? What else are you doing to grow your retirement?
Absolutely. And even if you feel like you're one point in time, I was like, yeah, I don't have any kids. I don't have any, I'm not worried about it, and now.
But who would it burden?
Exactly.
That's the other thing.
You're never too young to
If you don't have kids and you don't have a spouse, who are you going to burden if something happens to you? And most of the time, it's going to be your parents, unfortunately.
Or your brothers and sisters.
And for me, I don't want to burden anybody. That's why I got long-term care at 23 years old. I have life insurance at 23 years old. And to me, it's just another thing I budget in, and
Yeah, for sure.
It's a necessity to me.
Absolutely.
I'm a big believer in it.
Absolutely. Absolutely. Well,
Yep.
Kate, if people want to, get a hold of you, and how do they, what's that new website you got going on? If they
Just
want to
go.
talk to more questions
Yeah.
or,
I'm on
what's the easiest
Instagram.
way?
I'm on, yeah, I think just Instagram. But just go to my website, theinsuranceweaver.com. And my phone number's there. My email's there. Or you can hit the contact form and just put your name and number in. Or you can, like I said, text me, call me. If you have questions about your current insurance, give me a call.
Mm-hmm.
Even auto policies, sometimes we're just uneducated on auto and what it would mean and if something happens.
Right on. Right. So the insuranceweaver.com, and then you said your Instagram is the same thing.
At the Insurance Weaver.
Okay.
Yep.
All right. Sounds good. Well, I know who I call every single time I have any insurance stuff. Kate, thank you for being on the show today. Appreciate
Thanks for
having
having
you on.
us. Thanks for having me. Thanks for having us.
And again, this has been the Fire Chat Podcast. You can check us out online, firechatpodcast.com, here at the Fire Center, firecenterhq.com, or Fire Center HQ, or Fire Chat Podcast on pretty much every social medium. Again, my name's Rich Rice, and you can get a hold of me on Instagram at FireRichRice, or just pick any of those websites. My phone number, contact info is all over the place. So we do multiple events all centered around real estate investing here in Riverside, California at the Fire Center. And again, that website's firecenterhq.com. And hopefully we'll see you at an event soon, or just keep checking out the podcast. Leave us a comment, review, let us know what you think, and we'll see you real soon on the next one. Thanks, everybody.